In September 2009, in Phoenix, Arizona, Daniel Moreno, a 38-year-old air conditioning technician, stood in front of the 3-bedroom house he had just signed a contract to buy after 3 years living in his pickup truck. This house had once belonged to him. In 2006, during the market boom, Daniel took out a $280,000 loan with a near-zero down payment. The real estate agent told him that house prices only went up. The bank said that the 2-year interest rate adjustment was a minor issue. And the spreadsheet on the screen showed his net worth would increase by $40,000 in just 12 months. By 2012, house prices in the area had plummeted by more than 35%. Daniel's loan was nearly $90,000 more than the market value of the house. The interest rate adjustment had increased. He lost his house in an 11-month foreclosure process. 3 years later, an investment fund bought the same house for $125,000, nearly half the amount he had paid, and rented it back to Daniel for $1,450 a month. Daniel's story isn't a personal tragedy. It's a model. In 2 decades, housing in America has transformed from a basic shelter into a complex financial asset class, packaged, restructured, resold, and staked in global capital markets. The market value of residential housing in the U.S. now exceeds $45 trillion. That's larger than the GDP of many economies combined. When a roof over your head becomes collateral, when a home loan becomes a bond, and when that bond is traded as a yield instrument, the nature of housing has changed. What's happening isn't just a real estate cycle. It's a structural shift, from dwelling to financial weapon. For decades, the public has been told a fairly simple story about housing. It's a symbol of stability. A pillar of the middle class. The safest investment a family can own. Parents buy a house, pay off a mortgage for 30 years, and when they retire, they have an asset that appreciates over time. This model seems logical, even admirable. Policymakers reinforced that belief. Home ownership was encouraged as a form of asset building. Credit was loosened to make it accessible to more people. Lower interest rates were presented as a way to support first-time buyers. And when house prices rose, it was seen as a sign of a healthy economy. These explanations aren't entirely wrong. In many periods, house prices did indeed rise with income. Rising home ownership rates helped create a sense of social stability. Long-term mortgages spread risk over time. On the surface, it's a system that supports growth. But there's a gap in this official narrative. If housing is simply a place to live, why is the proportion of mortgage credit in the financial system growing faster than household income? If house prices only reflect supply and demand, why do they move in sync with global interest rate and liquidity cycles? And if the goal is simply to provide people with a roof over their heads, why are more and more homes being purchased by financial institutions instead of households? Since the early 1980s, when interest rates began their long-term downward trend, house prices haven't just risen with living standards, they've risen leveraged. Each cycle of monetary easing increases borrowing capacity, pushing asset prices higher than real income. As prices rise, mortgages rise. As mortgages rise, borrowing capacity continues to expand. A cycle forms. In this process, housing has gradually moved away from its original role. Instead of being just a usable asset, it has become a financed asset. Mortgage loans are packaged into securities. These securities are sold to global investors. Risk is diversified, but the incentive for profit is amplified. When bond yields fall, profit-seeking money flows into real estate. When the stock market is volatile, housing is seen as a safe haven. Thus, housing is drawn to the center of the credit system. It is noteworthy that each time the financial system faces a crisis, the policy response often increases the role of housing rather than diminishes it. After each recession, interest rates are lower than before. After each period of stress, liquidity is more abundant. And each such cycle pushes house prices to a new level. The safety narrative continues. But the underlying structure has changed. House prices no longer simply reflect where people want to live. They reflect where money wants to take refuge. It's no longer just a family decision. It's a capital allocation decision by investment funds, banks, and financial institutions. And when an asset essential to society's survival is drawn into the profit-making mechanisms of the capital market, its dynamics begin to follow a different logic. From here, the veil of illusion gradually lifts, giving way to deeper questions about the true workings of the system. To understand what really happened, it's necessary to separate housing from its familiar emotional shell and view it as a cash flow structure. A house, in the modern financial system, is no longer simply four walls and a roof. It is collateral. And collateral is the input material for credit. When a bank grants a home loan, they no longer hold that risk for 30 years as they did before. The loan is resold, consolidated into a larger portfolio, and then transformed into mortgage-backed securities. These securities are then stratified into different risk classes, tailored to the yield appetites of various investor groups. At this point, a crucial transformation occurs. The risk of a family becomes a global financial product. This mechanism creates a new incentive. Banks are no longer solely concerned with the borrower's long-term repayment capacity, they are concerned with the ability to sell that loan on the market. The more loans issued, the more fees collected. The cash flow from issuance fees, structuring fees, and transaction fees creates a chain of cumulative benefits. The incentive for expanding credit is no longer driven by actual housing needs, but by the need to create financial products. When interest rates fall, borrowing costs decrease. Buyers can pay a higher price for the same monthly payment. Home prices rise. As prices rise, the value of the collateral increases. Banks can grant more credit based on the new property value. Homeowners can remortgage, drawing on equity for consumption or investment. Money flows back into the system. A positive feedback loop forms. Credit creates higher prices create more credit. This doesn't stop at the household level. As housing becomes an attractive asset class, investment funds, pension funds, insurance companies, and then hedge funds begin to get involved. They buy thousands of homes to rent, transforming the residential housing market into an alternative fixed income market. Rental income is packaged into a stable yield product in a low interest rate environment. Housing, therefore, is no longer primarily dominated by buyers for occupancy. It is dominated by the logic of capital allocation. In this mechanism, a silent transfer of wealth takes place. When house prices rise faster than income, early property owners benefit. First-time buyers have to borrow more. The debt-to-income ratio increases. Monthly payments account for a larger proportion of household budgets. Dependence on credit deepens. The profits from property price increases flow to those who already own homes, to the fee-collecting financial institutions, and to investors holding mortgage-backed securities. Meanwhile, the burden of long-term payments falls on the borrowers. This is the process of wealth transfer through the credit structure. When the market rises, the system consolidates. When the market falls, its fragility becomes apparent. If home prices fall, the value of collateral weakens. Credit tightens. Cash flow reverses. Borrowers are trapped with debt exceeding the value of their assets. The policy response then typically involves injecting liquidity, lowering interest rates, and buying back mortgage securities, all aimed at preventing asset prices from falling too sharply. The system is therefore designed to prioritize price stability over access to affordable housing. This mechanism explains why housing is becoming increasingly expensive even as population growth slows in many areas. It also explains why interest rate cycles have a stronger impact on the housing market than any other demographic factor. Viewed through the lens of cash flow and the motive of self-interest, housing is no longer a purely housing market. It is a central link in the overall leverage structure of the system. And when an essential asset becomes the foundation for massive amounts of credit, any adjustment is not just a price adjustment. It is an adjustment to the structure of power and the distribution of wealth. If we compare current figures to pre-crisis periods in history, the picture becomes clearer, and also more unsettling. The ratio of house prices to household income in many major cities has far exceeded the long-term average. In some areas, first-time buyers need more than 8 to 10 times their annual income to own an average home. Before the 2008 crisis, this figure was considered a warning sign. Today, it is normalizing. The mortgage payment to disposable income ratio has also climbed to its highest level in decades. As interest rates surged in 2022 to 2023, the cost of borrowing to buy a home nearly doubled compared to 2 years earlier. A 30-year loan with an interest rate around 3% quickly turned into 7%. At the same home price, the monthly payment increased by hundreds of dollars. This not only reduced accessibility, it froze the market. Those who borrowed at low interest rates were unwilling to sell because selling would require them to borrow again at a higher rate. Supply decreased. Prices didn't fall proportionally to the interest rate increase because the market was locked by the existing debt structure. Simultaneously, the proportion of housing owned by institutional investors increased sharply in many states. After 2008, large funds bought tens of thousands of foreclosed homes at low prices, turning them into long-term rental assets. In some areas, first-time buyers had to compete directly with institutions that had access to cheap capital and the ability to purchase cash. Total outstanding mortgage debt in the U.S. now exceeds $12 trillion. This figure reflects not only the size of the housing market, it reflects the degree of integration between residential assets and the financial system. Going back to before 2007, we see a similar pattern: house prices rising faster than income, loose credit, widespread securitization, and the belief that housing always goes up. Before the 1980s savings and loan crisis, there was also a period of real estate credit expanding beyond actual absorption capacity. The difference today lies in the scale and level of global integration. The housing market is no longer a domestic story. Mortgage securities, real estate investment funds, and housing-related derivatives are all in the portfolios of international investors. When global liquidity changes, the impact spills over into local housing markets. Furthermore, house prices haven't adjusted as sharply as expected despite the strong interest rate hikes. This creates a state of tension. Affordability is decreasing, but prices haven't collapsed. The market isn't booming like before, but it hasn't cooled down enough to restore accessibility either. On the surface, the system seems more stable than in 2008. Non-performing loan ratios are lower, and credit standards are stricter. But the structure dependent on high asset prices remains intact. The middle class increasingly relies on home values to maintain a sense of wealth. The government relies on the stability of the housing market to protect consumer confidence. The financial system relies on mortgages as the foundation for multiple layers of credit. When comparing these indicators to previous cycles, we don't see an exact repeat of 2008. We see an evolution of the same mechanism: high asset prices maintained by a more complex credit structure, protected by more aggressive policies. The numbers don't immediately scream crisis, but they whisper of a prolonged imbalance, where affordability and financial value diverge ever further. And when that decoupling lasts long enough, the impact extends beyond the balance sheet. When home prices outpace incomes over an extended period, the consequences don't immediately manifest as a collapse. They build silently within the social fabric. The middle class, which once viewed home ownership as a crucial step in wealth accumulation, begins to diverge. Those who bought before the price surge benefit from capital appreciation. Their net worth swells on paper. They can borrow more on equity, refinance to reduce interest costs, or sell homes for substantial profits. Meanwhile, the next generation entering the market faces prices far higher than their incomes. Larger down payments. Longer savings periods. The age of first-time homeownership is rising. Many are forced to continue renting in an environment of escalating rents. This disparity creates a clear generational divide. Early property owners benefit from the price increase cycle, later entrants bear higher entry costs. As housing becomes the primary asset accumulation tool for households, being excluded from the market is not just a loss of housing, it's a loss of the opportunity to build long-term assets. Financial pressure thus spills over into other decisions. Couples delay having children because housing costs consume a large portion of their budget. Young people move out of expensive cities, altering the structure of the workforce and communities. Internal migration rates are increasing in some areas and decreasing in others, not entirely due to job opportunities but also because of housing costs. Surveys show that more and more people believe the dream of home ownership is becoming increasingly out of reach. When a symbol of social stability becomes a symbol of wealth inequality, confidence in the system erodes. This change isn't as dramatic as a banking crisis. It unfolds slowly, a family struggles to pay rent, a young person returns to live with their parents longer than expected, a couple decides against buying a home for fear of being trapped by a large loan in a volatile interest rate environment. Psychologically, housing used to be a safe haven. When it becomes the largest debt in a person's life, tied to interest rate volatility and market risk, that sense of security diminishes. Borrowers monitor interest rates as they monitor the market's heartbeat. Dependence on monetary policy becomes personalized. And when high house prices become a prerequisite for maintaining the financial stability of the system, policy is unlikely to allow for a sharp adjustment. Deep price drops would erode the net worth of millions of households, impacting consumption and weakening bank balance sheets. Therefore, political and economic pressures often favor maintaining high price levels, even if it reduces accessibility for future generations. Society is thus caught in a prolonged tension. Prices must be high enough to protect the system, but not so high as to destabilize it. In reality, this boundary is becoming increasingly fragile. Fluctuations in the housing market reflect not only supply and demand, they reflect the distribution of opportunity between generations, between owners and renters, between those with assets and those who haven't yet accumulated them. And when a roof over your head becomes the core financial instrument of the entire system, the question is no longer whether prices will rise or fall next year. The question is how long the system can maintain that fragile balance. There is a reality the system is not easily accepting. It has locked itself into an irreversible structure. Current house prices are not simply the result of supply and demand. They form the basis of the balance sheets of millions of households, commercial banks, investment funds, and financial products built on collateral. A deep adjustment not only reduces property values, it triggers negative asset effects, tightens credit, reduces consumption, and creates immediate political pressure. Therefore, whenever the market shows signs of slowing down, the response is usually some degree of easing, liquidity support, tax policy adjustments, credit stimulus. The system does not encourage price reductions, it encourages delaying adjustments. But delaying does not mean resolving the issue. In the current situation, homeowners with low interest rates are stuck because selling means borrowing at a higher rate. New buyers are stuck because costs exceed their ability to pay. Institutional investors are stuck because rental yields depend on high prices. Policy is stuck because it cannot allow assets to collapse, nor can it easily bring prices down to a level that matches income. This is a systemic trap. Everyone has an incentive to maintain price levels, but that very level reduces market flexibility. If interest rates remain high, liquidity is tightened, transactions decrease, and the market gradually freezes. If interest rates are lowered again to stimulate demand, prices may continue to climb, widening the affordability gap. Regardless of the direction, the fundamental structure, housing as the pillar of financial leverage, remains unchanged. History shows that periods of over-financialization of essential assets often end in a major redistribution. But redistribution doesn't always happen with a dramatic crash. Sometimes it unfolds over years of asset inflation, where those who already own continue to accumulate, while those who don't are forced to accept higher levels of debt or are pushed out. What makes this situation so stressful isn't a specific number, but the interdependence of its components. Banks depend on stable home prices to preserve collateral. the government depends on consumption supported by net assets. Households depend on home prices to maintain a sense of financial security. Investors depend on rental income and capital appreciation. When such a complex interdependence structure is inextricably linked, no adjustment is small. And that's why the housing story today is inseparable from the monetary story. When interest rates change, when global liquidity shifts, the impact doesn't just pass through the bond or stock markets. It goes straight to the home, the biggest asset in many people's lives. Looking back at history, this pattern isn't new. In many previous periods, when a society's basic asset became a central leverage tool, the cycle often ended with a structural adjustment, sometimes smooth, sometimes painful. The issue isn't whether housing remains a place to live. It still is. But when it's also the foundation of a massive credit system, any fluctuations in it have implications that extend far beyond the walls and roof. And when a society has to protect the price of its roof to protect its financial stability, a deeper question begins to emerge: are we protecting the house, or the leverage structure built upon it? For centuries, housing has been a symbol of material stability. A home is synonymous with shelter, with tangible ownership, with a sense of anchorage amidst market and political fluctuations. But as we enter an era of deep financialization, that meaning is gradually being redefined. When a home can be revalued by fluctuations in interest rates, when a mortgage can be converted into a security traded on the global market, when the value of a home depends more on liquid cash flow than on actual housing needs, the concept of ownership becomes more complex than it appears. A family may hold the property in their name on paper, but real control over its value is influenced by monetary policy, by the credit cycle, and by decisions of institutions beyond their reach. Housing, therefore, is no longer entirely a private space, it becomes part of the macro-financial architecture. This raises a deeper question about the nature of money and assets. Money is not just a medium of exchange, it is the instrument that values everything around us. When the money supply expands, when credit is encouraged, asset prices tend to rise. When liquidity contracts, pressure to adjust emerges. If housing is the largest asset for the majority of households, then the monetary cycle becomes an invisible force shaping individual economic security. In that structure, home ownership is no longer simply a personal decision about where to live. It is participation in a long-term financial cycle. Buyers enter the system with debt that lasts for decades, dependent on interest rates, dependent on asset prices remaining stable. Their security is tied to the stability of the larger system. And that system, as history shows, operates cyclically. From the financialization of land in 19th century Europe, to the Japanese real estate bubble of the 1980s, to the 2008 global mortgage crisis, the pattern repeats. When essential assets are used as a foundation for credit leverage, their value far exceeds their original function. When the cycle reverses, the adjustment is not just financial, it is a redistribution of opportunity and ownership. Today, we live in a structure where housing is both a shelter and a central financial instrument. Its price must be high enough to sustain the balance sheet, but if too high, it erodes accessibility and social trust. This balance is fragile and more dependent on policy than ever before. Perhaps the problem isn't with the house itself. The problem lies in how the modern monetary system forces every essential asset to take on an additional layer of financial function. When everything becomes an investment asset, the line between the need for survival and the need for profit blurs. A roof over your head remains a shelter from the elements. But in this era, it is also a link in the global credit structure. And when we understand that, we no longer see the housing market as a single price fluctuation. We see it as part of a larger monetary cycle where ownership, debt, and value are redefined over time. This cycle may continue for many more years. It may shift in ways few predict. But one thing is certain, when housing has become a financial weapon, its fluctuations are no longer just a story of the real estate market. It is a story of the economic power structure we live within. And when we understand that mechanism, we begin to realize that the issue is not just about buying or selling a house. The issue is understanding how the system is pricing our lives.